All right, let's dive right in. Today, we're unpacking an incredible story. Palo Alto Networks' massive shift from legacy hardware into an absolute AI-driven software juggernaut. Following their Q2 earnings, we're basically watching a company rewrite its entire DNA in real time to survive in a rapidly changing digital world. And honestly, the urgency here is kind of terrifying. Look at what their CEO, Nikesh Arora, said. AI is shrinking the cyber attack window to mere minutes. That explains exactly why the demand for next-gen defense is just skyrocketing right now. When you hear that their researchers ran a full simulated ransomware attack from the very first breach to stealing the data in just 25 minutes, yeah, it becomes incredibly clear that old-school security perimeters are completely dead. Section 1. The Q2 earnings beat. So looking at their fiscal Q2 2026 performance, they hit the top end of expectations across the board. On paper, it looks like a total clean sweep, right? You've got solid 15% top-line growth hitting $2.59 billion and incredible bottom-line efficiency with GAAP net income surging a massive 61%. But we really have to look under the hood here, because that 15% headline revenue number, it's actually a little deceptive since it blends two very different business trajectories into one average.
Section 2. The AI and software pivot.
To really understand their strategy, you have to separate the slow legacy business from their explosive new growth engine. It's basically a tale of two businesses under one roof. The physical firewalls, the actual boxes they used to be famous for, are growing at a pretty modest 10%. Meanwhile, their cloud and AI security software is literally flying off the shelves at 33%. And honestly, this internal rotation is exactly what you want to see as they transition into a much higher margin recurring revenue model. The absolutely crucial point here is this massive $6.33 billion figure for Next-Generation Security annualized recurring revenue. This proves the software pivot is essentially complete. They aren't just a hardware company trying to sell a little software on the side anymore. This new stuff, the cloud security, the AI security, it is the undeniable core of the entire enterprise. Now, before we look at the exact numbers, we really need to understand RPO, or remaining performance obligations. You can think of this as a giant financial shock absorber. It's essentially future money that's already locked in by contract, just waiting to be recognized. And that gives management tremendous visibility, even when the broader economy starts getting jittery. Sitting at a staggering $18.4 billion, this massive contracted backlog seriously de-risks the company's future quarters for investors. Total RPO actually grew 36% year over year. Think about that. When a company has that kind of huge revenue cushion just sitting in the wings, it provides incredible stability to execute on their long-term strategic plans.
Section 3. Buying growth through major acquisitions.
So, how does all this translate to their forward guidance? Well, they're pouring absolute fuel onto this growth fire through inorganic expansion. You almost never see a step function jump like this in a mature company. They are guiding to practically double their growth rate overnight, jumping from 15% in Q2 to nearly 29% for Q3. So you're probably wondering, what exactly is creating this vertical line straight up?
It's driven by massive acquisitions, specifically the multi-billion-dollar CyberArk deal, which perfectly plugs a glaring hole in their identity security platform. They're layering the revenues from CyberArk and Chronosphere directly on top of their already solid organic growth. Sure, it's bought growth, but it's highly, highly strategic. Section 4. The playbook for operating efficiency. Now, merging multi-billion-dollar companies usually destroys margins, mostly through the friction of integrating completely different systems and cultures. So how on earth does Palo Alto plan to stay profitable? Well, the CFO calls this their operational playbook. You see, Palo Alto has spent the last few years aggressively leaning out their own operations to achieve 3 straight quarters of 30+% operating margins. And now, they are incredibly confident they can drop that exact same blueprint onto their new acquisitions and run CyberArk significantly better than CyberArk even ran itself. Section 5. Risks, dilution, and premium valuation. While this whole transformation story is incredibly compelling, as objective analysts, we have to thoroughly examine the bearish concerns. Because let's face it, nothing in the stock market comes without a catch. It sounds almost too good to be true, right? So we have to ask the multi-billion-dollar question, is this operational playbook really a magic wand? Or what could actually go wrong with this massive expansion strategy? Well, if management takes their eye off the ball for even 6 months in the hyper-competitive cybersecurity sector, or if world-class identity talent walks out the door, the entire strategy is immediately at risk. Culture clashes are a very real phenomenon. If CyberArk's specialized engineers don't want to play by Palo Alto's new rules, your intellectual property literally leaves the building.
Then there's the number 773 million. That is the new upper limit for their guided share count, which represents a nearly 9 to 10% jump from 711 million. This highlights the very real, very heavy cost of shareholder dilution from these stock-heavy acquisitions. Simply put, to buy these companies, Palo Alto had to issue more stock. That means your existing slice of the pie just got a little bit smaller to pay for that forward growth.
And when you look at valuation, the market is currently assigning a massive premium to Palo Alto compared to industry peers like Qualys or Checkpoint. A forward price-to-sales ratio over 20 times means that absolute perfection is essentially already priced into the stock. There's literally no room for error here. Any slip-up in integration is going to be punished severely by the market. So as we wrap up this explainer, I want to leave you with this final thought. Palo Alto has made an absolutely incredible pivot into AI and software, but executing this massive consolidation phase is going to be their ultimate test. Will their ruthless efficiency successfully absorb these massive acquisitions, or are investors blindly overpaying for bought growth in a market that's priced for perfection? You're going to want to keep a very close eye on those margin numbers in the coming quarters to find out.